This week's in the market was one of the most eventful weeks that we've had since the war started, and I don't just mean the headlines. I am referring to the data, and the data is telling us a very interesting story. So today, I am going to walk you through what happened, show you some alternative data points that most people miss, and then share with you exactly how I'm thinking about positioning myself right now. Let's get into it. But before that, I want to share my thesis with you about the market now because I think everything will make more sense when you know how I'm looking at it. The war is definitely still extending. Oil is not coming down, even though Trump's deadline of April 6th is coming in less than 48 hours. But I think that there is still no clear signs of any ceasefire happening. And the Federal Reserve right now has no room to cut rates now as well. So more volatility is definitely likely, and sentiments is still at historic fear levels. And I think this will persist until we see Iran agreeing to some levels of ceasefire and not what Trump is saying. But when we look ahead, I am actually becoming a bit more bullish. Not because that the news, the geopolitical news, clearly there isn't any certainty there, but it's because the data that I am going to show you today will share with you that the fear in the market is reaching the kind of levels that historically have been very good entry points for investor. Now, let me quickly run you through what happened this week because every single day has something new, right? So on Monday, we saw US gas price hit $4 per gallon for the first time in 4 years. We are seeing strategic bombers, the B-52, flying into Iranian airspace. This is the first time in this conflict. And we also have the defense secretary coming out and saying that Hormuz is not US problem, or reopening it is not their core objective. So this is important, and I'll come back to it. And on Tuesday, Trump has threatened to bomb Iran's power plants, and Iran's response, their foreign ministry called the US proposal very unrealistic and unreasonable, and they also denied that there were any serious negotiations happening. So when Trump was saying they had great progress, no one knows what he is actually referring to. And on Wednesday, Trump actually gave his first national address since the war began. Now, I'll go deeper on this in a moment, but the overall short version is Trump doing his things, right? He's saying that the objectives is near complete. And basically, he said the same thing that he's been saying the past few days as well. But there was no form of de-escalation, and we saw markets sold off. And Thursday, this was the wildest single day. So the Dow dropped over 600 points, and then there was a headline drop about Iran and Oman, and everything reversed in just the next 30 minutes. So I will talk a little bit about that reversal and why it completely fell apart. And on Friday, we saw 2 US fighter jets shot down, and as of this video, both pilots have been safe, right? They have been rescued and they are safe and sound. And we also saw Iranian drones and missiles hit refineries in Kuwait and gas facilities in Abu Dhabi. Now, markets were closed on Friday, which means that when the market opens on Monday, it is going to absorb everything that happened over the weekend. Of everything that happened this week, Thursday was the day that tells us about how the market is behaving, because it was not just volatility, it was the market misreading a headline. Now, we know that Dow actually dropped 600 points and the Nasdaq dropped more than 2% on the day itself. And just 30 minutes later, Iran and Oman came out and said that they were drafting a protocol to monitor Hormuz Strait traffic. And this gave some reversal and some push to the market. But here is what's important. Monitor transit is not the same as opening the strait. What Iran was proposing is essentially a toll booth, right? That if any ship goes by, they have to pay a fee. And they want to sit at this entrance of the world's most critical oil gateway, okay, and supervise and coordinate which ship can pass. Meaning they will collect the fees, they will control the access, and they'll decide who gets through. Now, this tells us something very important, which is the market is still undecided about how to view this conflict. Is it going to end? Is it going to get better? Is oil prices going to reduce? That is still an uncertainty. And to understand it better, we have to go back to Wednesday, because Trump's address is really that main anchor of the whole week, which was what everyone was looking forward to, but there was nothing new that came out, right? Everything that happened on Thursday flowed from what he said, and more importantly, what he didn't say. So all of these pointers that you see him saying is actually nothing new. He even said that they will bring Iran back to the Stone Age. Iran's navy is gone and the air force is in ruins, right? So these are the few things, but here is my overall take on this. So the market was hoping for de-escalation. some sort of timeline, some sort of deal structure, and it got no new news. It was what has been reported. And the important thing is what he said over here, another 2 to 3 weeks. So what does this mean? This means 2 to 3 more weeks of high oil prices, right? And we already know how oil prices are affecting countries around the world. And this also means 2 to 3 more weeks of the Federal Reserve having absolutely no more room to move. This was actually just very, very recently, about 24 hours ago. Right, he actually said he remembered that he gave Iran 10 days to make a deal. This was his extension. Initially, it was a 5-day, but now it became a 10-day extension. And now it has become a threat once again before all hell will rain down on them. So you can see, on one hand, Trump is saying that Iran is asking for ceasefire. The US is willing to negotiate with them. On the other hand, literally just hours later, he is coming out and saying they will rain hell on them and things like that. And that's why the markets have kind of stopped believing what Trump is saying. And you can see that what he says, the market will just take into account initially and it reverses after that. And looking at the S&P 500 chart, we are seeing some sort of pattern that we saw back in March 2025. So back in mid-March 2025, we saw that the S&P, when Trump was announcing his tariff, it actually dropped 10%. Right below the 200 EMA, and we did find some recovery back above it, and right after that we saw another push down lower, all the way another 16%. Now look at where we are right now. There is some levels of similarity that we are seeing. Now we are down about 9%, very, very close to what we saw earlier back in 2025, and we are pushing right above the 200 EMA. We haven't officially pushed back up, but you can see we are testing it right now. So, it is possible that we might actually see some sort of continuous drop even after what we've seen, this 10% drop. We never know what Trump might do next. But it's also very, very important to know the difference between back in 2025 and right now. 2025, it was all totally controlled by Trump, right? It was he say when to stop tariffs, so on and so forth. But right now, there is that wild goose there, which is Iran, and everything is in a way dependent on how Iran will react right now. So the cards are not in Trump's hand. So this is that level of uncertainty, and we are also seeing how the market is reacting to this, of how we actually close even on Friday, that even though we turned green, we opened red and we turned green, we were still testing the 200 EMA at this level. So we have to reclaim this level if we want to see some continuous upside, at the very least, even a much more stronger confirmation if we were back above 6730 over here. Now, something interesting, we can see that in terms of a technical pattern, there is a little head and shoulders that is forming right over here. This is the inverse one, and the neckline right now is at a 200 EMA, right? So this is dependent on whether we will see Iran agreeing to some level of peace deal, right? And if it completes and breaks the neckline, that is a green light for more sustained recovery, but we need to see that confirmation. We are not there yet. Now, the Fed looks at inflation and also the jobs data. And on Friday, we had the March jobs report, and on surface, it looks actually pretty good. 178K added versus a consensus of just 60K, right? And that is the first thing. The second thing is unemployment. We creep down a little bit from 4.4 to 4.3%. So this is a good sign. When we look at the Fed Watch data, the FOMC meeting, the upcoming one, which is on April 29, it is confirmed that rates will remain the same. No debate over there. But I want to bring your attention all the way until December. You can see that right now, rates are still estimated to stay the same even until December. And what we see, how the market is forecasting, is only a drop in rate hikes probably after mid-2027 over here, right? So the whole idea is because with oil at a high price and inflation being very sticky, the Fed has very, very little room to move. And rates are right now locked over here. The good news is, at the very least, in terms of the probability, we are not seeing that high level rate hikes in 2026. The earliest will be in March next year as well. So we have war uncertainty, very high inflation because of oil, and Fed, which is stuck on both corners. And on paper, it sounds like a very, very terrible investing environment right now, and the market is definitely feeling it. right? In the fear of greed index, right now we are sitting at 19, deep in extreme fear territory. Actually, we did drop lower to, I think it was 10 few days ago. And for those who haven't heard me talk about this before, the fear and greed is built from very different, several market data inputs, right? The put call ratio, market momentum, so on and so forth. When the enemy reaches extreme fear, it basically signals simultaneously that investors are scared, that people are pulling money out of risk assets and moving to safety. Now, here's the thing about extreme fear. When you are at this level, you might think that your first instinct is that it's time to sell, it's time to get out. And every headline will just make it worse. Every headline will scare you to sell. But extreme fear has historically been one of the best setups for long term investors. And not because you can catch the exact bottom, but because you will be buying quality companies when everyone else is selling. Now, let me show you exactly what I mean. This is the S&P chart with the fear and greed index from 2011 until right now. Look at how extreme fear has historically signaled that we are forming a local bottom in the market over here. It ties in very, very nicely right over here. So this basically confirms what Warren Buffett is said, right? Be fearful when others are greedy and be greedy when others are fearful. And we are right at this level once again. And every time the fear and greed has hit extreme fear, this is a data that I plotted what happens to the S&P in the 12 months that follow, right? So look at back in March 2009, the GFC bottom, we were at 5, extreme fear was at 5, and 12 months later, S&P was up 68%. And COVID, we were at 12, 12 months later, we are 56%. And even in the most recent bear market in 2022, we even went lower to 2, extreme fear. And 12 months later, we are up at 24%. Right? And even in the just 2025, the tariff liberation day, extreme fear was also even lower, about 3 to 4. And right after that, less than a year later, market has recovered by 40%. And right now, we are at these levels over here. Now, there's still a question mark because we are leaving it right here, right now. But the research from what we see from 2009 until 2025 is very clear, which is that buying when we are at extreme fear territory gives you a very high probability of making money in the next 12 months. And what is interesting is that the fear and greed index isn't the only thing that is saying this, right? Look at this AAII survey. Now, this is the American Association of Individual Investors. It is one of the oldest sentiment surveys in the market. Now, there's a lot of data here, but what you're looking at is when the bearish sentiments has spiked above this level over here. Now, what do you notice, right? It's when bearish sentiments has spiked above that levels, and historically, looking at every instances since 1990, right? Every instances, the S&P has been positive 12 months later, 75% of the time. So just look at these levels over here. Only 2 times in 2007 and 2022 that it was negative, and it was by a small amount. Look at how much the 12-month change was a bigger positive gain than negative. And this is where we are right now, April 2nd, 2026. And it's a question mark because we are right in the middle of it. And historically, when everyone is bearish, when everyone is on the verge of capitulating, that is where the best long-term entry points appear. Okay? Now, let me show you one more signal, right? The last one is the VIX, right? All of this data is from Blue Curtic, so shout out to them. Now, VIX, you guys know, is the volatility index. And when it's high, it means that there is very, very high volatility and very, very high fear. And this week, VIX has fell below 25 after staying above it for about 8 days, right? So that is what this slide is telling us. So look at this table right over here. Every time we see this pattern coming out since 1997, again, the S&P has been positive 12 months later. And what is the average 12-month gain that we see right over here? The average 12-month gain is 11.3%, right? And very important, look at the max loss column, right? In none of these historical instances was the 12-month max loss worse than the maximum drawdown that we saw. Meaning to say that if you were patient and held through volatility, you almost never got caught in additional destruction or catastrophe downside beyond what has already occurred. right? So you've seen the fear and greed index, you've seen the consumer sentiment survey, and you've seen the VIX, right? All three historically associates with above average returns 12 months later. Now, does this mean that the bottom is already in? No, right? As you can see, based on the technicals, based on the news that we're seeing in, is still that level of uncertainty. But what it does mean is that the risk to reward for investors is starting to shift to a much more high probability rate. But here's the thing, staying patient doesn't mean doing nothing, right? It means using this time to identify where are the opportunities. Now, this is the S&P Tech Sector Forward PE ratio. NTM stands for next 12 months. Now, look at this chart over here. Right now, where are we? We are at 20.68, which is close to the levels that we saw in the 2022 bear market, right? And when we look at the bottom chart, so this is the ratio of the next 12 months tech PE over the S&P 500, all of the companies' next 12 months PE. Now, we are at 1.05. Now, what does this mean? This means that tech companies is trading only at a 5% premium to the market. Only a 5% premium, right? Compare it to when the AI hype was running around back in 2024. It was trading at close to 1.5 times, which is 50% premium. And right now, it is just at 5% premium, and AI is getting more and more advanced, right? So investors were paying through the roof for this kind of AI exposure 1 year ago. And today, that premium has almost entirely been erased, even though with the advances that most companies are doing. So tech stocks are essentially trading at very, very fair valuations right now. For example, look at Microsoft, right? Where is their PE ratio right now? It is sitting at roughly 23. Forward PE is at 21. You can see that we are actually below their 5-year average right now, and their forward PE is even lower than what we saw back in 2022. Now, for a company that is right smack in the center of the AI revolution, growing revenue at what levels are we seeing here? Revenues at about 16% now. And with Microsoft Azure accelerating with Copilot embedded across every enterprise product, and now they are integrating every LLM inside. At these levels of valuation, it is very fair. And a decade ago, remember that Microsoft didn't have any cloud services, it didn't have AI. It was a much more slower business, and today they are fundamentally stronger, trading at a lower multiple. And we look at Meta. Meta, where are we right now? Meta, if you're looking at their forward P, is about 19 times. It's not as low as back in 2022, but it's definitely much more reasonable than the past 3 years, 2023, 2024, 2025, right? And Meta's ad business is still growing, right? Llama is genuinely competitive AI race, and Mark Zuckerberg has shown he can execute a turnaround, especially what we saw in 2022 when Meta, everyone thought it was going to die. Zuckerberg came in and turned the whole business around, came back massively. And when we look at one of the biggest players in AI, Nvidia as well, right? Looking at their forward P, it is at 21 times. It is way cheaper than back in the past 4 to 5 years, right? And it's because of how they have been growing their revenue and their profits over the years as well. The revenue is growing at a solid 65% now. At peak, this was trading at more than 100 times earnings. And now this multiple has compressed to a much more reasonable value, even as the business is growing. And Nvidia is the leader in providing this kind of graphics card in the AI space, right? The question for Nvidia right now is whether the earnings estimates will hold up in a slowdown, and that is a risk. But the valuations you can see is much more skewed towards having a much more reasonable long-term returns. Now, I'm not saying that these are like screaming, close your eyes and buy now, right? What I'm saying is that for the first time in a long while, right, these valuations that we are seeing for the Mac 7 companies is genuinely something that we haven't seen in many, many years, right? These kind of names, they were trading at 40, 50, 100 times earnings, and right now they are trading at multiples that make sense if you are a long-term investor. Okay, let me bring this all together, and I want to be super direct because I think it's the most useful thing as well. So here's my honest read. In the short term, we are still being cautious, right? War is extending, oil is still sticky, the Federal Reserve is still stuck. It's definitely not ending regardless of what Trump is saying every single day, and Iran has demonstrated repeatedly that it can hit the Gulf energy infrastructure despite what Trump is saying that they have their navy, their air force are down, right? Oil is above $100 means inflation is still sticky, and sticky inflation means the Fed is stuck. Now, but if we are asking me 12 months out, right? I am definitely a little bit more bullish when we're looking at the results. I'm looking at the data. And it's what I've just showed you, right? The three separate data points that I've showed you, it all historically associate with strong forward returns, right? And tech valuations have now resettled to very, very attractive valuations. And right now, the market has basically priced in all bad news and assuming that the war will not get resolved in the next 1 to 2 years. But do you think that the war will really not resolve in the next 1 to 2 years? I personally think that it will not. It will resolve within the next few weeks. Okay, so that is my stance. And what I'm personally doing right now is right now the opportunity is there. So I'm just taking my time dollar cost averaging into quality names, right? I think it's always prudent to not go all in at once because no one can time the bottom, right? Nobody can do it consistently. But at the same time, you don't want to be the investor that always sits on the sidelines and keep waiting and waiting and waiting because the data is telling us right now that when investors wait for the all clear in the different bear markets that we saw, even last year, 2025, they end up missing the best part of the recovery, right? So what does this dollar cost averaging slowly means? So for me, it just basically means deploying a fixed amount at regular intervals based on technicals or based on valuations, right? And if the market goes lower, it's fine because you get to DCA a lot more. But if the market recovers from there, you are already in, right? And this removes the emotional decision from investing, which is one of the hardest thing to master, right? And in other direction, when you remove the emotion, that is your edge in investing. Okay. Now, of course, moving ahead, there are two scenarios that we will look out for, right? If Hormuz reopens, this is where we will get some level of relief. The market will love it because it means inflation will possibly come down and it gives the Fed more room. Now, the UN is also voting to pass and reopen the Strait of Hormuz, and right now they are at a standstill. But if let's say the vote continues to stall, right, and then they come to a decision, this is where we will see oil prices staying elevated, and this is also dependent on Trump and what Trump say and what Iran is going to do. Now, which scenarios will play out? Honestly, I have no idea. Nobody can tell you. But what I can tell you overall of what we are seeing now is that every single time preparation always beats prediction. Know the names of the companies that you want to add, right? Not everything is at a discount. You can't be buying every single stuff, right? And look at the valuations, look at the technicals, and look at how the data is telling us. And of course, look more of the forward returns that we are seeing now, 12 months ahead, right? Because if you are doing that short-term trade, you are basically trading on what Trump is going to say, and there is no guarantee that what he says might actually cause the market to move in whichever direction, right? Because now he can say something, the market might get that positive bump in 2 minutes, and right after it just sell back down, right? So don't let noise make decisions that your long-term self will regret. So that is my overall read for this upcoming week. So I hope that what you got from this, is a much clearer way of thinking through what the data is actually saying versus what the headlines are screaming. So if this was useful, do share with someone with your friends who you think this might help them. And be sure to also hit that like and subscribe button down below. It will really help me to create more of such content for you. So thank you, and I'll see you in the next one.